On this story itself, about these two companies seeking a truce, I mean, is this just the fact that it is costing more and more money to get faster and faster, right?
Yeah, absolutely. It's an arms race. You mentioned it, and nobody wins an arms race in the end. No one ever has. And what's happening is that the revenue associated with these smaller gains that they're making in speed, it's not enough to cover the costs that are up there. So you're having problems. Some firms are going out of business. Some are trying to consolidate. But here's the problem with some of the HFT community is that once one person decides, I'm going to jump on that line, I'm going to get a new microwave network, I'm going to put lasers on top of a building, whatever it may be.
Everybody else has to do that.
Everyone else has to do it, otherwise there's an advantage. So that's what definition of an arms race. And it's still going on. There's no doubt about it. So even though there was a little consolidation, there's still a lot of spending going on.
Well, so what does that mean for the structure of the market then, Joe?
Well, the problem that we have is, and people have called us high-frequency trading critics, and to an extent we are, but we're really market structure critics. And the problem is the structure has changed to allow, it's been a fragmented market for years now.
Yeah.
We've got 11 stock exchanges, over 40 dark pools, and to connect those, that's where the speed advantages come into play. That's why all the money is being spent.
So it's getting more and more distorted, is what you're saying.
It's been distorted. They've kind of glued it back together with all these high-speed connections, but our point has always been that's not, real liquidity. That's fragmented liquidity. We'd rather aggregate it, and you don't need 11 exchanges and 40 dark pools. And even the high-frequency traders will say it's too many because they now have to pay to connect, not only for the hardware, but actually to the exchanges. They have to pay a lot of money for lines and so on. So it's cost prohibitive for them as well.
So Michael Lewis has an answer. And because he's making the rounds on this one-year anniversary of his book, Joe, his answer is to slow everything down. I want you to hear what he said about that.
If every exchange took every market took the responsibility to make itself fair by eliminating the speed advantages that they set, then the problems would go away. The problem is the exchanges sell the speed to the traders, so it's a big source of revenue for the exchanges. So it would be a collapse of their business model to do this.
Listen, we love Michael Lewis, and we love the book.
And he loves your book.
And we appreciate that. Anytime I can get a shout out from Michael Lewis, we'll take it. But it's really, you can't regulate speed. And we would never come in and say, technologically, we want to slow things down. That's not the right answer. I don't want to do that. What I want to do is have a fair market where he's right in that certain exchanges are selling privileges. Well, that's where we have to talk about it. There's something called a SIP, which everyone knows about now, versus with the direct feeds that the exchanges are selling. Those don't match. How can you ever get them to match? You really can't. So what you're going to try to do is speed that SIP up as much, and that's where the exchanges like NASDAQ, who runs the SIP, have to spend some more money in trying to do that. But it really is difficult. So one of the solutions have been, like IEX has done, is to slow down their market to try to match up those speeds. To an extent, it's worked.
So, well, what's the problem? So there's lots of rigging, quote-unquote, rigging going on right now. So, like last week, we were at the Futures Industry Association conference. We talked to Tim Massad of the CFTC, asked him about spoofing. Okay, so is that the latest thing? Spoofing.
Well, spoofing's been going on as long as markets have been here. But the problem now is that you have high-speed electronics where there are they're not obligated market makers anymore. They're just a bunch of prop traders. The cases that the SEC have been bringing, and the SEC has actually been, and the CFTC has been getting a lot tougher on this, it's prop traders who are out there layering the book and putting in fake quote bids and offers to try to get someone else to react. And that's illegal, and it should be dealt with. And the CFTC actually has a lot more power than the SEC on that. But the problem is, it's the high speed, and does the SEC have enough technology to catch it?
Oh, right, and enough people.